Yeah, this is one of the biggest risks that we see at the moment, and it doesn't really need any further bank runs or bank collapses to be delivered. We can see that credit conditions have tightened. We know that there's been deposit flight from some of the smaller and medium-sized banks in the US. They are going to take steps to shore up their balance sheet and protect their future. That is going to reduce credit availability in a period where rates are elevated and we may see another hike. All of this historically has been the exact pathway towards a credit crunch. And historically, when you see a credit crunch, it means recession. And so we can see that the risk of that recession coming through at the end of this year is really elevated. And that is what the market is starting to price in. When you see the market pricing in the risk of 3 or 4 rate hikes, that's not really pricing in 3 or 4 rate hikes. That's pricing in a 50% chance of 6, 7 or 8 rate hikes. This is a market that is saying we have a real probability of a deep recession. We're preparing for it. And the Fed it's all up to the Fed now to try and prevent that.
Yeah, it's interesting though, because markets seem to be really pushing this to one side, right? Most regional markets across Asia are expected to close out the quarter higher. We've got European stocks also tracking at a 3-week high. So why do you think that markets are putting that to one side? And also, what's the investment strategy moving forward here as we now pass the first quarter of the year?
Yeah, I think the recent price action that you've seen in equities, both here locally in Asia and across Europe and the US for that matter, that drift high that's been fairly well focused in on the tech sector is at least partly reflective of yields that have fallen quite sharply over this quarter. And it's just given a bit of a valuation boost in those growthier parts of the market. And that's something that tends to happen fairly mechanistically when yields fall. If we go out over 3, 6, 9 months, as we start to see the real reduction in credit availability, it's going to come through in those surveys. That will probably result in labour hoarding starting to reverse and the US labour market really starting to weaken. In that situation, lower yields are bad for equities. And over the last week, we've seen lower yields being better for equities. So that reversal is still on the cards. And what is the way to protect against it in our view right now? It's shortening up duration in your government bond portfolio. It's looking for that downside protection while yields have backed up a little bit recently. Lock it in, protect on the downside, because if a recession comes, that's going to be the place to take cover.